What mistakes have I made with my own investments? What is my asset allocation? And what mutual funds, ETFs, and individual stocks do I own? We'll answer these questions and more on this, the 29th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody. Welcome to day 22 of the 31-Day Money Challenge. We have been working our way through a host of investing topics, everything from how we should think as investors, why we should think as business owners rather than some folks just rolling the dice with the stock market, what an asset allocation plan is and how we build one, how we pick mutual funds. Once we've got our asset allocation plan figured out, how we find mutual funds that will help us implement that plan, the importance of fees and how to determine how much your portfolio costs you. We've interviewed some great folks along the way. And so I thought today what we would do is I'd grab the old spreadsheet where I keep our investments and I'd kind of walk through our asset allocation plan and what we invest in. And originally I wasn't sure if I was going to do this because, what I don't want to do is for folks to think that this is the way that they should invest. I mean, what is best for you may be and very likely is very different than what works for us. I mean, certainly when it comes to an asset allocation plan, I think there's a range of reasonable choices that depend on a host of issues, including your ability to tolerate a down market and your financial goals. And then in terms of specific investments, part of the choices that I've made are a result of what I have available to me in my 401k. Some of the decisions I've made certainly reflect my view that on the whole, passive index funds are certainly what should represent the core of someone's portfolio. You may disagree. That's my view, how I've invested for a long time. I also invest in individual stocks, which is something that I think for a lot of people it's just not necessary and could even be harmful to your wealth long term, depending on how you do it. But I also thought that if you're kind enough to follow this podcast and spend a part of your day listening to what I have to say, the least I can do is walk through how I invest our portfolio. So that's what we're going to do today. I'm going to walk through my asset allocation and then the specific investments that we own in light of that asset allocation plan. Also, we'll talk about a couple of, really two of the big mistakes that I've made in the past investing. So that's what we're going to cover today. Before we get to it, I want to just say thank you to our two sponsors of this 31-Day Money Challenge. The first is Betterment, an online platform that helps you invest your money in stocks and bonds. You just pick what percentage you want in each. Betterment does the rest. They rebalance your portfolio for you automatically. They also reinvest your dividends. You can check them out at betterment.com. And Personal Capital, it's a free online tool that allows you to track all of your investments. You can set it up so they automatically import your investments. It will then track your performance for you. It will show you the cost of all of your investments, including your 401k. It will also show you your asset allocation across all of your investments. Very easy to do. You can check them out at personalcapital.com. Okay. So let's start with a couple of mistakes that I've made investing. As if you've listened to the other investing podcasts, you know that when I got started investing, this would have been about 1993, I think. I didn't have anyone to help me. There was no internet to speak of where I could go out and do a lot of easily do a lot of research. But I knew I wanted to invest both in a 401k that I had at my job then. And I also wanted to invest outside of a 401k. I actually remember going into a bank. It was First Union Bank, which doesn't exist anymore. They got bought. And I went into that bank. You couldn't buy a mutual fund online. You couldn't open an account online. That didn't exist. So I went into the bank and spoke to their brokerage arm, and I didn't know what I was doing. And the guy there, put me into a fund with a front load A shares. It has a fee that you have to pay. I think it was 5.75%, I think is what it was, but I may have that wrong. But it was a big upfront fee. That's, by the way, on top of expense ratios That was just the fee of for the privilege of investing in this mutual fund. And of course, he got a big fat commission out of that. Well, actually, it wasn't that big and fat because I didn't have that much to invest, but he certainly took a chunk of my change. And it wasn't necessarily that the mutual fund was that bad. I actually don't even remember which one it was. But I just, I didn't appreciate the significance of costs. And that actually continued for a while. And that was, probably my first big mistake. But, the good news there is I was making a mistake on a small balance. It's one thing to make that mistake when you get started and you're investing a couple $100 a month maybe, or $1,000 or $5,000 or whatever you have. If you have 100,000, 250,000, 500,000, $1 million, 5 million, wherever you are, and you start to make either of those kind of mistakes, it's going to leave a mark. Fortunately, I was making that mistake with not a whole lot of money, and it took me a while to figure out how important fees were. I mean, that wasn't the only time I bought an expensive mutual fund, and I think at one point my expense ratios were over 1% in total until I started to realize how important expenses are and started to focus on index funds a lot more. But slowly I learned, and then I guess that's the point, right? You learn. So that was one mistake that I made. I think the other one was simply just not saving enough. I look back, and we always saved, but I look back, probably the first 10 years out of college, and we could have saved a significant amount of money beyond what we did. And had we done that then, I think we're doing fine now, but I can imagine what we would be doing, what position we would be in had we been a little smarter with our money. If you're listening to this and you're in your 20s and you're thinking, well, I don't make a lot of money to begin with, what's the point? If I can save an extra $50 a month or $100 a month, what difference is that going to make? Over the long term, you do it month in and month out, it will make a huge difference. It may not seem like it at first. In fact, it won't seem like it at first. It may even seem silly at first. But give it a year, give it 2 years, give it 5 years. It won't take that long, and you'll look back and you'll see your balance, and you'll think, okay, this is making a difference now. And I think once you get to a certain point in your accounts, whatever that is for you, it could be 5,000, 10,000, 15,000, you'll get to a point where you say, hey, this is real money. That $100 a month, $50 a month, $200 a month, $500 a month, whatever it is for you, yeah, this does matter. This does make a difference. And I think you'll find it very motivating. At least I do. And it's true whatever your goals are. Your goals might be, people talk about goals and the number, but, your goal might be you want to give a lot of money away someday. Wouldn't that be a great goal? Not to save $1 million, to give $1 million away. That may seem crazy, but and maybe your goals are different, but, it's not all about what you can do with this money. Obviously, there are goals like saving for a child's education, of course, for retiring. But, you may have other goals too. And these small amounts of money, particularly when you're just getting started, will go a long way over time. And it'll help you to reach those goals and maybe to achieve goals you haven't even dreamed of yet. So, okay, with that, those are sort of the big mistakes that I made. I guess they weren't too terrible. Like I said, I made them early, at least on the expense side. That's a good thing. So what about today? What do my investments look like today? So I've got all of my investments on a single spreadsheet that I'm looking at now. And I'm going to walk through the mutual funds, and I own, I think, one ETF. I've owned others in the past. I'll talk about the individual stocks a bit, but I'm going to focus more on the mutual funds. So what's my asset allocation? I guess that's the starting point, right? If you've been listening, that before you even get to what mutual fund should I buy, you got to figure out your asset allocation. And the most important question there is how much do you put in equities, stocks, right? And how much do you put in bonds? So for me, that split is 80% equities, 20% bonds. And I include in equities what others might call alternative investments. We'll talk about those in a minute, but things like REITs and commodities. I kind of group all that together in the equities section of my asset allocation plan. So I have 80% in stocks and 20% in bonds. And now I'm in my I guess late 40s now. Some would view that as aggressive. I don't know. Maybe some would think it's not aggressive enough. I'm comfortable with it. I think as I get older, I will start to shift more towards bonds. And in fact, I'll probably let the 20% start to drift a little bit even now, maybe up to somewhere between 20 and 25%. But that's what I'm comfortable with. That right there is, in terms of an asset allocation, and I'm going to break it down further. But in terms of asset allocation, that is the most important decision in my portfolio. That right there. How much you have in U.S. equities versus international equities versus REITs versus commodities. What kind of bonds do you own? You have government bonds, corporate bonds, bonds from foreign corporations or foreign governments. Those are certainly important questions, but they're not as important in my view as the very first question. How much do you put in stocks? How much you put in bonds? And one of the things that I have to appreciate as I make this decision for me is that with an 80-20 split between stocks and bonds, my portfolio could easily go down in value by 40% in 1 year. That will happen. In fact, if I keep it this allocation until I retire, let's just assume that for a minute, I can almost be assured I'm going to have a bloody year 1 year where it's going to be a bloodbath, and I'm going to lose, again, it could be, I say 40%. I think historically that's the number that they tend to associate with an 80-20 allocation, but whatever, it could be 30%, it could be 45%. It's going to be an ugly year, and the thing that I have to know about myself is, am I going to stick to this plan? And something to think about. Let's assume equities go down significantly. Let's say bonds that year do okay. It's not enough to know, can I keep myself from fleeing the stock market? I'll actually be buying more equities that year, right, as I rebalance. Because the value of my equities will go down, the value of my bonds will go up. That will throw my allocation off. So I'll be selling bonds, the one thing that's doing well that year, to buy equities, the one thing that's just going down, by the day. And so that's something that you need to decide for yourself. I think it's easy to read a book, read a blog, whatever, and think, 80-20, 70-20, 100% stocks, whatever it is for you. But you really got to think, what am I going to do when the market's down? If you've been investing for a while, one question to ask is what you did in 2008 and 2009. And I can tell you, for me, I stuck with my plans. I didn't sell any investments. I didn't flee the stock market. In fact, I made some investments. Actually, some of the best investments I've made were in that time period. I bought a bank stock, Citibank, that did very well for me. And I also bought a ITB is the ticker. It's a exchange-traded fund that focuses on housing, which, as everyone knows, was just a disaster back then. And that actually did extremely well for me. And my analysis was no more than, housing's down terribly. This ETF is cheap. I have no idea what the market's going to do in the next year or two, but I do know and believe that eventually housing will return. And whenever that happens, the investment will do very well. And that's pretty much what happened. So, okay, so 80-20 split, equities to bonds, stocks to bonds. Now, for my equities, I subdivide that into, I guess, 3 buckets. 40% of that goes to U.S. equities, 25% goes to international equities, and the remaining 15% goes to alternatives, REITs and commodities. And the first thing I'd say about that is there's no magic in those numbers. It's not as if these are the numbers. Some suggest you have U.S. equities and international equities of the same amount. So they might suggest 30 and 30, let's say, with the rest in alternatives or something like that. There's no sort of real detailed data analysis that I came up with. It's just what I was comfortable with. I certainly want international exposure. Part of that is that for my REITs, which account for 10%, half of that is in foreign REITs. So actually my international exposure is a little higher than 25%. It's more like 30%. And the other thing to keep in mind is, these buckets are not, they spill into other buckets. And for example, if you invest in an S&P 500 index, that's all U.S. companies, you actually have significant international exposure. I mean, if you think about it, what's one of the biggest companies, right? Apple, right? Well, Apple's performance depends in a very significant way on its sales overseas. It is absolutely impacted by international markets. And the same, all of the big companies are the same way. McDonald's, GM, Ford, Microsoft, Intel, right? They have significant operations overseas, many of which more significant than they have in the United States. So in any event, that's kind of where, thinking through those issues, I was very comfortable with the 40% U.S. equities, 25% international equities, and then the other 15% in alternatives. But again, there's no magic to that. If someone came with a different split, I'd have I think I could have made a number of different choices that would have been reasonable as well. But I break it down further. So For my U.S. equities, I've got 40% of my total portfolio in U.S. equities. 20% of that is in the large cap stocks, right? Think S&P 500. I'm not getting to the mutual funds yet. I'll get to those in a minute. But 20% is in sort of the large U.S. companies. I have 10% in mid-sized companies that focus on value companies, meaning companies that are undervalued. And I have 10% in a small cap fund that focuses on value companies. So why do I do that? Why not just have one total stock market index fund for the whole 40%? And the reason is small caps and to a lesser extent mid caps, while they're more volatile than say an S&P 500 type company or type fund, over the long term they tend to return a slightly more. And the same is true with value companies. Now, is there a guarantee that will continue in the future? No, not at all. But I like that extra exposure to the smaller companies and to value-oriented companies. And so that's my reason behind that allocation. For my international stocks, which again total 25%, I just have two categories, just sort of the developed market or total sort of market of international stocks. That's 15%. And then I have 10% in emerging markets. Now, emerging markets, smaller developed countries economically. And so why do I do that? Kind of the same reason I do have a little extra in small caps and value funds for the U.S. class. Emerging markets are extremely volatile. I've been investing in emerging markets since about 2003. Actually, this is another mistake I made. I invested in emerging markets. I had no idea what they were. I just thought they were just an international fund. I had no idea the difference between an emerging market and a developed a fund that focuses on more developed countries economically. But I bought the Vanguard Emerging Market Index Fund, and I'll talk about that in a bit. And I had no idea what I was doing, but one year I'd be up literally like 60% in that fund. And the next year I'd lose 40%. I mean, that's how crazy emerging markets can be. I kind of laughed last year. There were some articles talking about how volatile emerging markets were because they were down 10%. And I'm thinking 10%, that's nothing. That's a walk in the park for emerging markets. So why do I bother with that? Well, I think it gives my portfolio good diversity. And meaning, again, not all of my investments are moving in lockstep. So that's one reason. And then again, over the long term, I think they perform really well. If you can handle the volatility and you've got, a long time to invest, for me anyway, I like emerging markets. And I separated out, I could buy, as we've talked about, sort of the Vanguard Total International Stock Index Fund. We talked about that I think in yesterday's podcast. It has some exposure to emerging markets, but I want to control that a little bit more and have a little bit more exposure than what you typically get in a single fund to cover the international markets. So that's what I do there. And then the last section for equities is the alternative investments. And I have 10% in REITs and 5% in commodities. And again, the main purpose here is just to give my portfolio some added diversity. Those asset classes, again, tend to do fairly well over the long term. Commodities can be really volatile and really swing in different ways than stocks. So it gives me a good bit of diversity. On the REITs, I tend to divide it between two Vanguard funds. I'll get into those in a minute, but I focus on half of it in a U.S. REIT and half of it in international REITs to give, again, just some more diversity. And so that's what I do for my equities. So I'm just looking here in total in terms of subclasses. So I have three sort of high-level stock classes: U.S. equities, international equities, and then alternatives. And then within that, I have, three subclasses for U.S. equities, right? Basically large, mid-cap, and small cap. I have two subclasses for the international, sort of just a general international fund, and then some additional exposure to emerging markets. And then on the alternatives, again, just REITs and commodities. So that's what I do there. And by the way, I'll leave some kind of chart in the show notes so you can see this. And then for bonds, I tend not to get all that crazy with bonds. There are all kinds of different bonds. You have government bonds, both U.S. and foreign, and then within that you can have short-term, intermediate-term, long-term. You can have corporate bonds. Again, short-term and long-term. You can also have corporate bonds with different credit risk ratings. So, for example, if you want high yield, otherwise known as junk bonds, you can do that. Also for government, I forgot, you've got, of course, inflation protected bonds like TIPS and I bonds, right? You've got municipal bonds, local governments. So, you could, bonds bonds are a lot more wild than people, I think, perhaps realize. People kind of view them as the safe thing, but the bond market is wonderfully complex and interesting. And I, by and large, ignore it all. So I just have really one class of bonds. In the perfect world, I just have a single bond fund. Your sort of your Vanguard total market bond fund. I end up having two, and I'll talk about that. I'll talk about that in a minute and why. But I tend not to break it down between international and U.S. My goal for the bond fund is to give my portfolio some stability, and so I'm not looking for exotic bonds. I'm not looking for example, for a emerging market bond fund, which Vanguard offers, or junk bonds. And a lot of people do, and if you do, that's great. I don't think it's a bad thing. I've just chosen to simplify the bond portion of my portfolio. Frankly, I think my portfolio is complicated enough, and I'm fine doing that. And that's it. That's my asset allocation. I think fairly simple. It's certainly changed over time. It's gotten a little more complicated as I've had more to invest, but still, I think, pretty straightforward. So now the question is, all right, that's the asset allocation. What do I invest in? Well, let's walk through it. Let's just start right at the top. The U.S. We'll talk about the U.S. equities. So the sort of large companies. Here I have really two classes of investments. The first is an S&P 500 index fund. And I have a Fidelity fund. The ticker is FXSIX, FX6. And I'm going to type that into Morningstar and just take a quick look at it. And you might be saying, well, why this particular fund? By the way, its expense ratio is super low, 4 basis points, 0.04%. And the reason I have this fund is because it's in my 401k. So it's very inexpensive. It gives me coverage to the S&P 500. I might go with a total market fund if I had it, but it's not in my 401k, and so I don't. And then the other thing I do for large U.S. equity is I have individual stocks. And that's probably for another podcast as to why I do. I'm actually putting together an article on how my individual stocks performed in 2013. I've actually, over the number of years, outperformed the market most years. I didn't outperform the market in 2013, which does not surprise me at all. It's hard to outperform the S&P 500 when it has, one of the best years it's had in 2 decades, 32%. I think including dividends, I think last year my stocks returned between 25 and 26%. I will have an article on that. But I have large companies that everyone's heard of. I own Berkshire Hathaway, which, by the way, I took my wife and daughter to the Berkshire Hathaway stockholders meeting last year in Omaha. Got to hear, from Bill Gates and Warren Buffett. Bill Gates is on the board, Warren Buffett, Charlie Munger. It was, and my wife and daughter, who are not really into investing, had a ball. It was a lot of fun. Anyway, so I own Berkshire, I own Apple, I own Pepsi. Because Pepsi tastes better than Coke. Sorry, it does. Sorry, Mr. Buffett. I know you invest in Coke. Pepsi tastes better. And Verizon. I'm trying to think what else. I think that's just about it. Oh, and Ford. I own Ford. What I found, by the way, on my stock investments, I've owned other investments as well. I've owned McDonald's, Citibank, which I bought when the banking industry was not doing well in 08 and 09. I've owned Cisco. What I found with my stocks is that the investments that have done best for me are the ones that I buy because I think the stock is cheap, as opposed to I've also made purchases because their dividend yield was high. But what I've found is when I'm buying stocks because they're cheap, I do the best. And the most recent example is if you follow individual stocks, you know that Apple was over 700 at the end of 2012, and then it started to fall all the way down into the high 300s last year. And at 395, I doubled my stake in Apple. I said, this is just crazy. I mean, this is an example of the market that completely divorced from fundamentals. This company, sure, it has competition. Yes, I know one of its founders is gone. but it's got an incredible brand, an incredible balance sheet, and its earnings are fabulous. And we'll see how the investment does. Obviously, since I bought it, it's done very well. I bought it at $3.95. It's trading in the mid 500s, but so what? It could go down again tomorrow. So we'll see how it does. But when I invest in a stock because I think it's cheap relative to its value, not relative to what the market's going to do. When I bought Apple at $3.95, I had no clue what the market would do over the next year. But in any event, that's when I do the best. So that's my large U.S. equities, an S&P 500 index fund, Fidelity, FXSIX, and individual stocks. If I were going to do this with a Vanguard fund, I would go with the Vanguard Total Stock Market Index Fund Admiral Shares, which is VTSAX. I think that's an excellent mutual fund. For the mid-caps, I have a Vanguard Mid-Cap Value Index Fund, Admiral Shares, VMVAX. I'm very happy with that fund. And let me quickly look up. I'm going to quickly look up its cost on Morningstar. 10 basis points. Very inexpensive. Gets me exposure to the mid-cap market. That's what I have 10% of my money in. And again, it's value-oriented. So value would be companies that, and there's different ways to measure and to categorize companies as value versus growth. But basically think of value as those boring companies that no one really talks about, that are earning money quarter after quarter, year after year, and they're undervalued because they're not sexy, they're not exciting. No one's talking about them. Everyone's talking about Twitter. Twitter ain't a value company, and I just find that's the right way to invest. It's how I try to invest when I buy individual stocks, and I think exposure to a value focused fund for me is something I'm very comfortable with. So that's what I do for mid cap, and then for small cap, another Vanguard fund, Vanguard Small Cap Value Index Fund, Admiral Shares. The ticker there is VSIAX, and let's see what its expense ratio is. Should be it's still 10 basis points. I thought it was a bit more. So you can't beat that. 10 basis points for a small cap value fund. It's phenomenal. And so when you add all that together, the Fidelity, S&P 500, the individual stocks, the mid cap fund, the value, the small cap fund, great exposure to the U.S. market at virtually nothing. I mean, the stocks, of course, don't have an expense ratio. You have to pay a fee to trade them. But I have a brokerage account at Scottrade. It cost all of $7. Last year, I made one trade, and that was to buy my Apple stock. So I spent $7 last year for all of my individual stocks. So between all of that, great exposure. Again, could you do it in a much more simply? Sure. Just the Vanguard Total Stock Market Index Fund is one that I like. And I slice and dice it a little bit more, but that's it. That's what I do for U.S. equities. All right, so international equities. Well, I have a couple of funds here. And again, part of this is because I've got some in a 401k where I have to work with the choices that are available to me. If you have a 401k and you've dealt with this, you know exactly what I'm talking about. You've got to work within the options they give you. And then I have some of this in like a rollover IRA at Vanguard where I have more control. So it turns out I have 3 funds for my developed countries and then 1 fund for emerging markets. So for the developed countries, the one fund that I have in my 401k is Dodge & Cox International Stock Fund. This is an actively managed fund. This is not an index fund. And the ticker is DODFX, and you'll see this in the expense ratio. It's more than what we've been looking at. Let me look it up real quick. I think it's 64. Yeah, 64 basis points. Still not horrible. Certainly for an actively managed fund, it would be considered quite good, but it's obviously a lot more than, say, the 10 basis points we were looking at for some of the U.S. funds. Of course, generally, international funds are going to be more, even for an index fund. But I've been happy with this fund. It's one of the options I have in my 401k that I'm comfortable with, and it's actually beat its index for a very long time. You know, if you've listened to my podcast, you know that I'm a big believer that funds won't do that forever. I do think as you move out of, say, the U.S. markets and you move into international markets, or and particularly other exotic markets, emerging markets, for example, it actually gets easier to beat an index with an actively managed fund. Now, hey, if you disagree with that and you've got some studies you want to throw my way, shoot me an email, dr@DoughRoller.net. But that's been my experience. As you move out of the U.S. market and out of sort of the large cap type funds in the U.S., it gets easier to beat an index. But again, when I invested in Dodge and Cox, it wasn't because I thought it would beat its relevant index. It was because I thought it was a solid fund with good management, and it was what was available to me in my 401k. I've been very happy with it. The interesting thing about this, when you look at its performance, and I'm pulling that up now in Morningstar, is that when the market is up, it will beat its index. And when the market is down, it will lose more than its index. So, for example, this past year, Dodge & Cox was up 26.31. The index it tracks, it was up 22.78. So it beat the index by a little under 4%. Compare that to 2008, when the market was down, the index that it tracks that are relevant to this fund lost about 43%. Dodge & Cox lost almost 47%. Yeah, 1 year, almost half. Didn't sell any, though. Kept investing in it and kept making contributions in my 401k to it. So that's the first fund for developed countries. And then the other two are both Vanguards. I have the Vanguard Total International Stock Index Fund, Admiral Shares, VTIAX, an excellent fund. I think if I were going to pick just one fund to cover all international investments, this would be the fund. It's phenomenal. Its cost, let me look it up real quick, 14 basis points, really inexpensive. Really inexpensive. Now it's interesting when you look at it and you compare it to Dodge & Cox. So Dodge & Cox was up, 26% last year. This fund was only up 15%. So it actually underperformed an index. The index funds almost always do. But this is where you start to think, well, goodness, why would I invest in this fund? Why not Dodge & Cox? And part of the answer could be invest in both. I guess that's what I do, although, again, I do that more because it's in my 401k and it's the option that I have. But the thing you got to do is think long term. We're looking at this, over not even 10 years, but 20, 30, 40 years. And so if you're going to pick an actively managed fund, you got to really ask yourself, am I going to stick with it if it starts to underperform? Because what happens is when it starts to underperform, and particularly in a bad year, you sell at the worst time. So in any event, I have this fund. I like it a lot. That's the second of three developed country international funds. The third one is very similar, Vanguard Developed Markets Index Fund, VDMAX. The reason I have, you say, well, why do you have two Vanguard funds? It's really more for historical reasons. I had invested in this fund years ago. Frankly, I don't remember even why I picked this over another one. And I've just kept the money in there. I don't really like selling my investments, to be honest with you. And as I look it up, I realize I've got the wrong ticker symbol. So I'll have to, it's not VDMAX. I'll have to look that up and I'll include it in the show notes. But it's the Vanguard Developed Markets Index Fund. Do I need that? No, I could just take what's in there and probably put it in the VTIAX, the Vanguard Total International Stock Index Fund. And heck, I might even do that. But it's certainly a good fund as well. And between those three, I've got the international markets covered very well. And then for emerging markets, I have the Vanguard Emerging Markets Stock Index Fund, Admiral Shares, VMAX, VEMAX. And I'm looking that up now. This should be higher. Well, it's still only 15 basis points, I think part because it's Admiral Shares. But this gives me great exposure to emerging markets. As I mentioned, if you're going to invest in emerging markets as a separate fund because you want more exposure to emerging markets, you really need to appreciate that you're going to have some rough years. In 2008, this fund lost almost 53%. I didn't sell any, but who likes to lose that kind of money? 2009, though, if it helps, it gained 76%. 1 year. Isn't that amazing? Then it gained 19%. Then it lost 19%. This past year, 2013, it lost 5%. It is a wild ride. That's why I only have 10% of my portfolio in it, but it gives me great diversity and a great exposure to emerging markets. So that's what I do. It's very inexpensive, like most Vanguard funds are, and I've been very happy with it. I've invested in that fund for over 10 years now. So that covers international equity. So now we've got REITs and commodities. So what I do here. So for REITs, I have two Vanguard funds, one a Vanguard REIT Index Fund, Admiral Shares, and then a Vanguard Global REIT Fund. So the U.S. fund is VGSLX, and I'm looking that one up as well. Again, it's low cost. It gives me great exposure to REITs. It's 10 basis points. And it can, like some of these other sort of narrow niches, like emerging market funds, REITs can gain a lot in 1 year and lose a lot in 1 year. So you just need to be prepared for that. I'm looking at its performance over a number of years. It lost almost 40% in 2008. Of course, the next year it was up 30% and then 28%. This past year it was only up 2.5%. REITs generally didn't do well last year. And some view them as a good buy now for that reason, thinking, well, now they'll start to perform better. For me, I just stick to my plan. I've got 10% in REITs. That's what I have in REITs. And that's what I'll have at the end of this year, regardless of how they perform. So that's the first one. And then the foreign REITs is VGRLX. Again, another Vanguard fund. And this is actually a fairly new, I've had this for a couple of years now, as I recall. And it's a little more expensive, 27 basis points. It's just because investing in international REITs is just more expensive. And but it gives me, I like the sort of international exposure. So that's what I do for my REITs. And then for commodities, I've moved outside of Vanguard. I have an ETF, which, if you're not familiar with ETFs, I mean, they basically function just like a mutual fund in the sense that it owns shares of a lot of companies, just like a mutual fund does, but it trades like a stock. So the price of an ETF, the price of a mutual fund gets set at the end of each trading day. And if you're going to buy and sell shares of a mutual fund, you're buying and selling with the mutual fund company. With an ETF, you're buying and selling with other investors, just like you do stocks. And as a result, the price of the ETF changes throughout the trading day, just like a stock does. But like a mutual fund, it invests in many companies, depending on what its goals are. And for commodities, I have the PowerShares DB Commodity Index ETF. The ticker is DBC. And as I recall, this one's probably my most expensive fund, I think. Let's see here. Yes, 85 basis points. This is an expensive fund. I only have 5% in it, and it's to give me exposure to commodities. I don't want a fund. Some funds, just to give you an example, you want to invest in gold. What are your options? Well, you can invest in the actual gold. I mean, again, whether you go buy it and bring it home or stick it in a safe or you pay someone to hold it for you, you could invest in gold. Another way to do it would be to invest in gold mining companies, right? Well, the pure play there is to invest in the gold. Why? Because the gold mining companies, their performance certainly is affected by the price of gold, right? But it's also affected by a lot of other things, right? Their ability to mine the gold, how efficient they can operate, distribution networks, and all this sort of thing. And so if you're really wanting exposure to gold, for example, and for me, it's best to own the gold. Again, whether you there's plenty of ways to invest in gold and not to have to physically hold the metal. Now, I'm not a big believer in investing in gold. I think it's pointless. I think gold, it doesn't have much intrinsic value, doesn't have a whole lot of industrial applications. I just don't see any reason to invest in gold. But I do want to invest in commodities, which might include even some gold. I'm okay with that, but you're looking at other kinds of precious metals. You're looking at things like wheat and oil, and it's much more diversified. And so that's what I have. I have the PowerShares DB Commodity Index. It actually tracks a futures index as opposed to, say, the spot price of a commodity, but that's fine for my purposes. And again, I only have 5%, but I like the added diversity that it gets me, and it can go up and down significantly, just like some of these other asset classes. And last year it was down 7%. So, but that's okay. It's got 5% of my portfolio, and I'll keep it at that, whether it's going up or going down. So all of that adds up to my equities portfolio. Not too bad. I'm looking to see. I've got 1, 4, 5, 6, 7, 8, 9, 10. I guess 10 mutual funds. More complicated than you have to have, as you know. I mean, we've walked through before in previous episodes how you can have a really great portfolio with just one fund or with just 3 funds. But this is what I have. And I've kind of, as we've gone through it, walked through why. Bonds now. Bonds are pretty easy for me. I have two funds. I have the Total Bond Market Index Admiral Shares Fund from Vanguard, VBTLX. I've owned this for a while. Gives me great exposure to the bond market. And low fees, 10 basis points, 10 basis points, so 0.1%, very, very inexpensive. Now, I have a second fund, and why is that? So this kind of gets into asset location. You have both tax-deferred or tax-advantaged accounts and taxable accounts. Is there any reason to hold certain investments in one versus the other? And generally, the answer is yes. For those investments that are going to throw off a lot of interest and dividends and capital gains, it's best to hold those in tax-advantaged funds where you're not going to pay taxes on them now. Until, you won't pay taxes until, say, you retire and you start withdrawing the money, like a 401k or a deductible IRA. So the general thinking there is you'll want bond funds in a tax-advantaged account, like a 401k, because they throw off a lot of interest, and REITs, which do the same thing, and perhaps other funds that generate a lot of dividends or capital gains. And then for other investments, holding them in your taxable account is okay. I do have one bond fund in my taxable account, and it's partly because it holds to some extent, or I look at it as the possibility of needing it for emergencies, and I like the stability. And what I have is a Vanguard intermediate term tax-exempt fund. It's VWIUX. I picked that in part because of its tax-exempt. So it's invests in muni bonds, among other things. Municipal bonds, which have some tax advantages. So I avoid the taxes that you'd normally have to deal with if you held a bond fund in your taxable account. It's very inexpensive, 12 basis points. I don't put a whole lot in Morningstar's star ratings, but it does have it's a 5-star fund for what that's worth. I'm looking at that now, noticing that for the first time. I didn't know that when I bought it. I don't put a whole lot of weight on that, but I've been happy with this type of fund for this purpose. It's a great example, though. Of course, bond funds can lose money. This fund lost about 1.5% in 2013. And that certainly happens from time to time. But generally, it does pretty well, and it rounds out my bond portfolio. So all of my bonds are in those two funds, and that's it. And that really is it. Those are my investments. I hope you've kind of found this helpful, or I don't know. Like I said, you can simplify it more than I have. Of course, a lot of people get a lot more complicated than I do. I think our portfolio is fairly simple. But if you have any questions, feel free to email me if you want me to want to understand more detail why I've made certain decisions with my investments. You can. My asset allocation is where I plan to keep it. Like I said, I might drift it a little towards bonds, but it's not going to be significant. And I probably will be investing in some more individual stocks, but I'm not. I like individual stocks. I want to keep it, though, to a certain amount. I don't want to get too carried away with individual stocks, and I don't like owning a lot of them. If I own 4 or 5, I think that's enough. But there may be 1 or 2 that I look at this year, and I'll be talking about that as the year goes on. And so that's it. That's my asset allocation. That's my investment portfolio. As I said, if you have any questions, let me know. And with that, we need to cue up the music. There we go.
To the DoughRoller
Oops,
podcast.
Wrong one. Let's try this one. Oh, that's better. Still learning the technology. Well, that brings the show to a close. As always, you can check out the show notes at DoughRoller.net/podcast 29. You can reach me at dr@DoughRoller.net. I read every email, respond to every email. You can leave a voicemail, speakpipe.com/DoughRoller. If you want to subscribe to this podcast, go to DoughRoller.net/iTunes. You'll be redirected to the iTunes page where this podcast resides. You can subscribe and leave a review. And if you haven't already, check out our newsletter. Just go to DoughRoller.net/newsletter. It's a free newsletter that I send out every Saturday. Try to pack it full with resources and tips that help you make the most of your money. So that brings the show to a close. Remember, until next time, the best thing money can buy is financial freedom.